Oil prices are on a roller coaster. No seatbelt, no warning. And investors are screaming louder than theme park kids. If price swings make you nervous, but strategic, listen up. Commodity prices can flip faster than a storm front, and in the complex global economy of 2026, these shifts are more than just numbers on a screen. They are the undercurrents that will define corporate profits, geopolitical power, and the stability of our supply chains. It's time to plan your move on a rapidly changing chessboard. So, what's driving these seismic swings? It's a perfect storm of interconnected factors. Take oil, the lifeblood of industry. Geopolitical tensions in key producing regions and carefully calibrated signals from OPEC Plus can send prices soaring or plummeting overnight. A single drone strike or a surprise production cut announcement ripples through every sector, from transportation to plastics manufacturing. Then there's the weather, increasingly unpredictable and extreme. Unprecedented droughts can decimate wheat harvests, while floods can shut down critical copper mines. These climate shocks are no longer black swan events. They are a recurring feature of the market, creating fundamental supply-demand imbalances. Add to this the fluctuating cost of shipping. A spike in freight rates, driven by port congestion or new environmental regulations, can make even cheaply sourced materials prohibitively expensive by the time they reach the factory floor. In this volatile environment, the line between winners and losers is drawn with brutal clarity. For manufacturers, especially in automotive and electronics, rising copper and steel prices squeeze margins to the breaking point. They face a difficult choice: absorb the costs and sacrifice profitability, or pass them on to consumers and risk losing market share. Airlines are another clear example, where every dollar increase in the price of jet fuel translates to millions in added operational costs, directly impacting ticket prices and route viability. Conversely, food producers who manage to secure grain supplies before a price surge can gain a significant competitive advantage. And for the miners and energy producers themselves, high price cycles can mean windfall profits, funding new exploration and technological investment. The key differentiator is foresight, the ability to anticipate the swings and position accordingly. Beyond market forces, the very architecture of our supply chains is a source of risk. The era of seamless, just-in-time logistics is being tested. Supply chains wobble with shocks to foundational commodities like oil, copper, and wheat. But the real hidden traps lie in policy. A sudden tariff announcement can invalidate months of financial planning, while unexpected export bans, often used as a tool of economic statecraft, can sever access to critical materials overnight. These disruptions create logistical choke points that cascade through the system, extending lead times and forcing companies to hold more inventory, tying up capital and increasing warehousing costs. The strategic calculus is shifting from pure efficiency to a new emphasis on resilience and redundancy. This volatility is redrawing the global map of trade. Alliances are shifting as buyers chase reliable flows. The United States and the European Union are increasingly focused on friendshoring, strengthening supply chains with politically aligned nations to mitigate risk. China, in turn, is securing long-term contracts for resources across Africa and the Middle East, locking in supplies for its vast industrial base. Meanwhile, emerging powers like India and Brazil are navigating this new landscape, leveraging their own resources to forge new partnerships and claim a greater share of global value chains. This isn't just trade, it's economic diplomacy played at the highest level. So how can firms navigate this treacherous terrain? The playbook for 2026 requires a multi-layered strategy. First, financial hedging. Using futures and options contracts can provide a crucial buffer, locking in prices for future needs and protecting margins from sudden spikes. Second, smarter contracting. Moving away from reliance on spot markets toward longer-term agreements with trusted suppliers can ensure both price stability and supply security. And third, true diversification. This means not just having multiple suppliers, but having suppliers in different geographic regions to insulate against localized disruptions, be they political, economic, or environmental. Let's consider two brief scenarios. A construction firm that failed to hedge its steel and copper costs faces a 30% price surge. Its project margins collapse, leading to losses and potential defaults. In contrast, a competitor who used forward contracts and diversified its sourcing from both domestic and Latin American suppliers weathers the storm, delivering its project on budget and capturing market share from its distressed rival. The same story plays out for a food company. One faces soaring wheat prices and is forced into panic buying, while another, with diversified grain sources and a solid hedging program, maintains stable pricing and reinforces its brand reliability with consumers. Staying ahead requires constant vigilance. What should be on your weekly dashboard? First, monitor inventory levels for key commodities. Falling stockpiles are an early warning of a price squeeze. Second, track commodity spreads and futures curves to understand market sentiment. Third, keep a close eye on freight indexes like the Baltic Dry Index for signs of shipping strain. Fourth, follow meteorological forecasts for key agricultural and mining regions. And finally, watch Purchasing Managers' Indexes, or PMIs, for a real-time read on industrial demand. 2026 isn't just about growth, it's about how firms secure the inputs to achieve it. Buckle up. The next swings could shape margins for years to come. Follow Econmatrix for daily global economy news updates in 30 seconds. The global economic landscape is in constant flux, with commodity markets at the heart of this volatility. Staying ahead requires more than just data. It demands sharp, actionable insights. To navigate the complexities of price swings, supply chain disruptions, and geopolitical shifts, you need a reliable source. We break down the critical trends and what they mean for your business and investments, delivering clarity in a complex world. Follow Econmatrix for daily global economy news updates in 30 seconds.